Okay, just a reminder that I have a live session beginning at 6 p.m. Eastern Time, which is New York time or Toronto time, if you think better geographically. I had mentioned this last week that I would do a live Q&A session beginning at 6. 6 is a nice time because Globex opens and market opens at 6, so we get our first look at, how everybody thought over the weekend, although it rarely ever follows through to the next morning, but it still gives us something. Anyways, there it is. It is 9:17 a.m. as I'm doing this, and this is saying live in 8 hours. I'll see you then. Well, the excitement in the yield curve still continues to be in the 1 month, up 20 basis points over the last week, sitting at 5.79. May 11th hit 5.81. Look at the 2 month, down 36 basis points to 4.87, all over the debt ceiling debate. 18 days left, June 1st. We'll see if we can get some kind of progress out of Washington. If we are going to get some kind of progress, it'll be 5 minutes to midnight at the end of May. If we think June 1st is the ex-date, there'll be something like at 5 minutes to midnight. That's just how Washington works. So I don't know that I would be looking for any kind of big breakthrough this far out. The Republicans seem pretty adamant about getting spending cuts. The Democrats seem pretty adamant about no conditions to raise the debt ceiling. That's a pretty wide gap between the two. But it is causing a lot of interesting things to happen in the 1 month and 2 month. I did buy T-bills maturing June 15th. I think I got 5.4 something yield on it. I just couldn't get as much as I wanted to buy. There just isn't volume on the bid and the ask on those. So, I put my bid out and I got what I got. And I'll try again this week. I'll see where it goes. We got a lot of Fed speak coming up this week. And I think that's where the risk is in the Fed speak for the week. Earnings pretty much done. We get some big retailers this week, but the quarter is pretty much in the books at this point. You had some Fed speak last week that didn't really gain the attention I think it deserved. So we'll go over the two statements that were made last week that I think we really need to pay attention to. And look who you've got this week. Monday, you've got 4, Bostic, Kashkari, Barkin, and Cook. Tuesday, you have Mester, Bostic speaking twice, Barr giving testimony, Williams and Logan. Thursday is Jefferson and Barr continuing on with the testimony from Tuesday. Friday, Williams and Bowman. And the big one here, 11 a.m. on Friday, Powell. It's a discussion with Powell and Bernanke together. I don't know who's moderating it, but it is a discussion. This is live, by the way. If you go to the Federal Reserve's site and look for the speech calendar, whenever the governors or the Fed chair are giving speeches, not any of the other presidents of any of the other central banks on this list, but just the governors and the chair whenever they're speaking. The text of their speech is there, and if it's live, you'll have the live link. This one is live, so you can watch that one live. Curve inversions, 312 days now on the capital market inversion, the 2 to the 10. The money market to capital market inversion, 179 basis points, been 200 days now. May 4th, 189 was the deepest inversion for this cycle. The 3-month, 18 months forward minus a current 3-month inverted 220 basis points. That's unchanged week over week, and that's using 3-month SOFR. For the Fed balance sheet, not a lot of activity here. The SOMA up 100,000. That's probably just adjustments from the tips. So basically unchanged week over week. The balance sheet itself from the Federal Reserve, I couldn't get an update. The May 3rd is the last update there was. So I'll just report the last numbers, 8.5 trillion. Money market funds continue to see inflows increase by another 18.33 billion. Retail, 12.25 billion. Institutional, another 6 0.07 billion. This is interesting as well. Among taxable money market funds, government funds increased by 9.35 billion. So there are still inflows into these securities, and with the yields that they're offering, especially the money market yields, 5.79 for 30 days. Look at the 3-month 5.25, the 4-month 5.27, 5.16. With everything going on, with the debt ceiling debacle, with the uncertainty around where interest rates are going, money is still moving into treasuries, still seen as safe, and it is competing with money that would be going into equities. And based on what we saw last week, there seems to be this willingness of the market to want to go higher, but an unwillingness to actually go higher. Every time there was any kind of red ink on the screen, it was met with some green ink, but up to a certain point, and it just can't seem to get past the 41.50 to 41.75 range. Let's look at the 5-year CDS, the U.S. Treasury 5-year CDS, 65.34. And this is as of May 13th. United States 5-year CDS value is 65.34. This value reveals a 1.09% implied probability of default on a 40% recovery rate. These two charts are the same thing. All I've done was I've taken this section of the chart and just made it bigger so that you can actually see, the increase going on here. This is March, here is May, and you can see from the basically end of April, beginning of May, just started increasing. This is over a longer period of time, April 17th to May 23rd, and we're up here, so you could just sort of see exactly how elevated it is over that period of time. CDS values changed 1.51% during the last week, 55.68% during the last month, and year over year, that spread is up 300%. This gives you the 1 week, 1 month, 6 month, and 1 year performance of that of the CDS. 64.37 a year ago, 15.9. Okay, next FOMC meeting, 31 days away. We get the May 3rd minutes in 10 days. Probabilities going into June. Probability for 0 basis point dropping, and now down to 84%. For 25 basis point increase up to 15.5% from 8.5%. Same with December. The weighting of the probabilities are going to higher, and I think you're going to see that creep in every week once the market starts to see that as long as nothing is breaking, rates are not coming down. Even if inflation does come down, rates are not coming down. Now, how can I say that with such conviction? You have to listen to what the voting members are saying, and none of them are saying that rates are coming down. They would have to see a sustained period of disinflation before they'd even consider it. They may be considering a pause, but rate cuts are off the table probably till, mid-2024, end of 2024, unless something breaks. So 4.25. 23% dropped to 15%, 4.5 from almost 50% down to 44, 4.75 from 24 up to 32. 5% is now at 7.5, and basically here is where we are right now because I used the upper part of the range, 5.25. Yeah, it's small, but it went from 0.1 to 0.6, but the weight, the distribution of the weightings is pushing more towards the upper end of the range. Effective federal funds rate 5.08. Reverse repo up 21.78 billion. No relief on that yet, sitting at 5.05. So there were two Fed officials speaking last week. Michelle Bowman, who is a governor, and Philip Jefferson, who's been nominated for vice chair. They both spoke, and I think it's important to listen to what they're saying because both of these are voting members. While Philip Jefferson will be a voting member as the vice chair, Michelle Bowman's a governor, she's a voting member. So in her speech, paragraph 2, in my view, our policy stance is now restrictive. But whether it is sufficiently restrictive to bring inflation down remains uncertain. Some signs of slowing it in aggregate demand, and then it continues on, are evident, but this is from paragraph 2. Paragraph 4 has the punch. Should inflation remain high and the labor market remain tight, additional monetary policy tightening will likely be appropriate to attain a sufficiently restrictive stance of monetary policy to lower inflation over time. Two statements, two things are wrapped up in there, and you can really see the focus on their dual mandate. Should inflation remain high, labor market remain tight. Right now, we have both of those conditions. We'll look at CPI and PPI that came out last week, and if you look at the month over month, it increased, not just a little. In some categories, it increased quite a lot month over month. So inflation is remaining high, and we'll look at a couple of ways. We'll look at a number of different measures of inflation that they look at, and we'll see that on some of them, it's higher than what just CPI or PCE are showing, especially when you get to the trimmed means PCE and CPI. Should inflation remain high and the labor market remain tight, additional monetary policy tightening will likely be appropriate. Well, you have a check mark on both of them so far. So this does not sound like a person who is thinking that in July the first rate cut will happen. The market has it priced in, but this does not seem like a person who thinks that. I also expect that our policy rate, and this is important, that our policy rate will need to remain sufficiently restrictive for some time to bring inflation down and create conditions that will support a sustainably strong labor market. And I think that is what is being missed in market participants suggesting that, well, inflation will be coming down, we'll see it by July, by August, the Fed will cut rates to start supporting growth, is that they're just looking at, well, if inflation comes down, they'll start to cut rates. This is a compound sentence, right? Our policy rate will need to remain sufficiently restrictive sometime to bring down inflation and create conditions that will support a sustainably strong labor market. So inflation coming down is one part. But conditions to support a sustainably strong labor market is the other part. That you're going to have to see slack in the labor market to get done. It's not enough to see inflation come down if the job market remains tight. Rates are not coming down. Now, that's not my opinion. That is what she is saying here. She's a governor and she votes. And this is her mind. So I'm getting a glimpse into her mind. This is basically how I would bet that she would vote. I don't see a rate cut in here. Of course, the economic outlook is uncertain, and our policy actions are not on a preset course. I will consider the incoming economic and financial data during the intermeeting period and its implications for the economic outlook in determining my view of the appropriate stance of monetary policy. I will look for signs of consistent evidence that inflation is on a downward path when considering future rate increases, not future rate decreases. I will look for signs of consistent evidence that inflation is on a downward path when considering future rate increases. Read it. This is what she's saying. And at what point we will have achieved a sufficiently restrictive stance for the policy rate. So she's looking for it to come down in her assessment of, well, should we increase rates? And are we sufficiently restrictive? Nowhere in there she's saying in considering rate cuts. Read it again. Signs of consistent evidence that inflation is on a downward path when considering future rate increases, not future rate cuts. In my view, the most recent CPI and employment reports have not provided consistent evidence that inflation is on a downward path, and I will continue to closely monitor the incoming data as I consider the appropriate stance of monetary policy going into our June meeting. This is a person who's voting who's saying, I don't see any progress. I don't see anything. So I know that some people in the comments have pointed out, but inflation is this, and it's coming down, and it's going to be 2% to 3% by November, and yeah, maybe. But these people don't share your view. They don't share your opinion, and these are the people who vote. Philip Jefferson. I have an arrow here because we have to go to another screen. Let's see what he has to say. Okay, we're not going to read all of it. This is from May 12th on the assessment of current monetary policy. And he starts off by saying, hey, some good news. I got nominated. Deeply honored by it. Let's go right to introduction here. The title of the conference, How to Get Back on Track, a Policy Conference, is potent. Its intent and ambiguity are striking. First, the title presupposes that U.S. monetary policy is currently on the wrong track. Second, the webpage for this conference advances a puzzling definition of the phrase on track. How so? According to the Hoover webpage, a key goal of the conference is to examine how to get back on track and thereby how to reduce the inflation rate without slowing down economic growth. As this audience knows, there are macroeconomic models that permit disinflation with no slowdown in economic growth, but the assumptions underlying these models are very strong. Because I have been asked that before, is it possible that inflation goes away without the economy slowing down? It is, but you have to assume a lot of things going on at the same time. And he says that here. That's why I wanted to read that. The assumptions underlying these models are very strong. It's not clear, at least to me, why such a strict metric would be used to assess real-world monetary policy making. Third, the definition of on track in the title contrasts with the more commonplace definitions such as achieving or doing what is necessary or expected, as offered by a standard reference such as the Merriam-Webster Dictionary. My view is that this commonplace definition provides a more practical lens through which to assess real-world policy making. And then he just lays out what he's going to talk about. Let's just, we're going to read the current inflation in the U.S. and labor market and GDP growth, but we won't bother going into the banking sector stress. The link to this speech is in the comment section, so you can read it if you want. Current inflation is still high. Figure 1 illustrates this point. Let's have a look at Figure 1. So in the black is PCE, the red is core PCE. There we are for March. He doesn't have it updated for April. We're not going to get this is PCE. We won't get that till the end of the month, but you can see where the 2% line is down here. You can see where it is up there, right? Let's close that. Figure 1 illustrates this point. Personal consumption expenditure inflation, the black line, stands at 4.2%, and core PCE, the red line, stands at 4.6% for the year-end March 23. Overall, news on inflation so far this year has been mixed. This is a pretty important paragraph here. The good news is that food and energy prices both fell in March. Total PCE inflation slowed to 4.2% from 5% in February. Since peaking last June, inflation has declined about 2.75 percentage points. And here's the punch. With nearly all the step down explained by falling energy prices and slowing food prices. The bad news is that there has been little progress on core inflation. Again, this is somebody who's going to vote. We want to understand what they are seeing, not what we're seeing. Unless we have direct communication with this person and we can put stuff in their face and we can talk them into our position, our belief is meaningless. It's what these people believe, right? To understand why I find it useful to separately analyze three large categories that together make up core PCE: goods, excluding food and energy, the red line in Figure 2, housing services, the black line, and services excluding housing and energy, the blue dash line. The drivers of inflation in each of these sectors differ somewhat, and understanding the different causes and how they affect the different components can help predict the future course of inflation. Let's look at Figure 2. Okay, the black line, there's housing. We can see that extremely elevated. Here, the red line, that is goods, ex food and energy. And here is services, ex housing and energy. And he's going to make a point that we've seen little progress there, and look at it. There it is right there, sitting between 4 and 5. It's basically going sideways at this point, and that's what he sees. Core goods inflation has come down since its peak of 7.6% in February 2022, but the most recent news has been discouraging. Outside of used motor vehicle prices, which fell unexpectedly in March, disinflation in core goods prices is occurring at a slower pace than expected. Supply and demand imbalances in the goods sector seem to be resolving less quickly than expected. Core services inflation, the black line figure 2, surged over the past couple of years as the demand in the housing sector underwent a major shift during the pandemic. The latest monthly readings have started to slow, though that is not yet evident in the 12-month changes shown in figure 2. The recent slowing was presaged by a flattening out of rents on new leases to new tenants since the middle of last year. In contrast, core services excluding housing inflation, the blue dashed line in figure 2, has not shown much sign of slowing. Labor market GDP. Turning to the labor markets, April 2023, employment report data continue to point to a strong labor market amid improvements in labor supply, with the prime age labor force participation rate exceeding its pre-pandemic level. Wage growth has continued to run ahead of the pace consistent with 2% inflation and current trends in productivity growth. Wage gains are welcome as long as they are consistent with price stability. Over the 12 months ended March 2023, the employment cost index for total hourly compensation for private sector workers rose 4.8%, down only a little from its peak of 5.5% last June. Despite strong growth in consumption spending, gross domestic product grew modestly at an annual rate of 1.1% in the first quarter of 2023 as inventory investment slowed down substantially, similar to the below-trend pace of growth in 2022. Looking ahead, last quarter's growth in consumer spending seems unsustainable. Indeed, after rising very steeply in January 23, consumer spending ticked down in February and was flat in March. Moreover, I expect slower consumer spending growth over the remainder of the year in response to tight financial conditions, depressed consumer sentiment, greater uncertainty, and declines in overall household wealth and excess savings. Okay, so we've been through two of them, two very important ones because they are voting members. They are not heads of any of the banks. They are on the governing council, and one being proposed for the chair, the vice chair. I'll get it, the vice chair. In assessing what we think monetary policy will be, there is the data that we can then look at, but it's not our opinion of the data. And I think that's where some market participants may be going wrong, is that they're looking at the data and they're saying we're seeing it coming down and thinking the Fed's reaction function will be to lower rates in response to that. Not a single member of the FOMC, not a single one is saying that. Only the market is saying that they're going to cut. In fact, most of them are saying we're not cutting. We are not cutting. We need to see a sustainable decrease in rates just to stay on pause. Michelle Bowman says we need to see that just to not consider more rate increases. No one is talking about a rate cut. And I think the market has to shift from thinking about, well, here's what the data says, hence this is what the Fed will do, to what does the FOMC see when they look at the data, and what is the FOMC most likely to do regardless of what I think inflation is doing? Real yields have all increased. Fairly large increases on the 5 and the 7, 18 and 14 basis points, 10 basis points on the 10-year. And break-even rates have all decreased except on the 30. No change there, but they've all come down. If we look at Fed funds futures, the index bottoms out now, June and July at 94.915, implying a rate of 5.08, which is pretty much where we are now. Last week it was bottoming out in June at 94.93 at 5.07, so a small increase, almost nothing there. For December, 95.51 from 95.58. Which is implying a rate of 4.49 instead of 4.42, so it's 7 basis points higher. And I think this is how it's going to sort of play out, is that every week it'll kind of just drop slightly like this until you get to December, which will be sitting around the 94.75 to 95 range. So it's got quite a ways to drop. Again, that only applies as long as something doesn't break. If something breaks and it's significant, this curve will steepen incredibly, because the belief will be that the Fed will now be forced to cut rates. So if you are betting on rate cuts, that is the environment that you need to happen, is something really bad that forces the Fed to cut. In which case, if you're waiting for rate cuts to be in equities, you do not want to be in equities under that scenario of a rate cut. If you're thinking that, well, the data will show them that they can cut, they are all clearly saying to you, we're not cutting. We're not cutting. We need to see a sustained period of disinflation. Not just heading to 2%, but a sustained period. If you're thinking about cuts, you're thinking sometime mid-2024 to end of 2024. Not 2-3 meetings later, they're just going to turn around and start cutting. The pivot, there is no such thing as a pivot here. It is the pause and then a long pause. How do I know that? Because they're saying it. They're all saying it. Going into March of next year, 95.945, implying a rate of 4.055, and was 3.985 the week before, so you can see 7 basis points higher on that rate. I'm sure next week, at the end of next week, or next Sunday, this will also be higher than 4.05, and I think this will be higher than 4.49. With all of the Fed speak this week, I'm assuming they're pretty much all on the same page. I think hearing it from 6, 7, 8 different voices, the market will slowly start to say, hey, listen, the pause is not guaranteed and there is no pivot. You know, it is a matter of this is going to be the level we're going to be at for a long period of time, if not higher. December 24 over December 23 is 140 basis points lower. Now, this is using 1 month SOFR. So from where we are now to the end of December is a drop of 60 basis points with another 140 next year. So the market is thinking 200 basis points lower by December 2024. If the market is thinking that because inflation will come down and the Fed will just cut rates, I think they're wrong. What I think is the more likely and more correct interpretation of that is something is broken. Something is broken and the Fed will be forced to cut rates. And that something that breaks is going to have to be in the credit market. TLT registered a small loss over the week. SPY registered a small loss over the week. Implied volatility kind of disappearing here. 13-week IVP is the 8th percentile. It was the 31st percentile. I did use this week as an opportunity to roll my puts. I rolled the May 104s to June 104. I closed at 49 and opened at 177 on the June 104 put. So this worked out. That was profit. And we'll see what happens with the June 104 puts. All right, OAS, all across all the ratings have decreased over the week. We look at the 1-year U.S. Treasury at 4.75, the 2-year at 3.98, the 3-year at 3.65. This is the number of basis points to 5.11, and then I take a weighted average, 91.6 basis points for the spread if you're going to be in U.S. high grade 1 to 3 year versus the Treasury 1 to 3 year. Yeah, that seems like a reasonable spread. The spreads themselves are probably a function of two things. You have very strong balance sheets this time around. Number two, you have a drop of issuance of corporate bonds. So lack of supply will keep the prices elevated. This is an interesting chart. This is U.S. bankruptcy filings per year. This is as of May 2nd, 2023. From S&P Global Market Intelligence. Here is 2023. 236 U.S. bankruptcy filings this year. The dark blue here is the first 4 months, is January 1st to April 30th, 236. You got to go back to 2010 to exceed that at 325. The yellow is the remaining of the year, the rest of the year. So we're already at 236, and it shows you for 2023 where the level of bankruptcies are here. But put in perspective, you have these bankruptcies here. You had that sort of going on in 2020 after the pandemic. You had bankruptcies increase. Now, some of these are small to the point of saying, well, you know, that's a sort of churn that happens pretty much all the time. The biggest one in there, the most notable one, was Bed Bath & Beyond. And I think there were 5 or 6 that were over $1 billion. But there were a lot that were like under 50 million. I think there were some that were even under 5 million that are counted in here as well. So there's a lot of churn in bankruptcies anyways. It's just interesting that we're at 236. You got to go back to 2010 to get a number higher than that for the first 4 months. Okay, mortgage rates 6.35% as of May 11th. Looking at the spread of the 30-year over the 10-year, May 4th to May 11th, the U.S. 10-year was up 2 basis points. We see here the mortgage rate was down 4, so the spread decreased by 2. Agency down 3.17%. I did buy more agency, and I will continue to add to agency. Annaly down 1.47%. Arbor up 5.7%. I had sold the January 24, I hadn't sold. I was long the January 24 1250 synthetic. That is selling the put and buying the call to create the synthetic. Credit at 165 is now sitting at negative 0.91, so 74 cents basically per contract on those. DHI, Lennar, XHB, I'm selling 30 Delta puts every week, 2 weeks out. So every Friday you add 2 weeks out. So how that works is when you start, I'll just draw it out for you here. You'll sell 30 Delta puts 2 weeks out. The very next week you'll sell it 2 weeks out. The very next week these expire, you sell 2 weeks out. These expire, you sell 2 weeks out, and you just keep rolling them. The goal is to build an allocation. So this way here I get very effective dollar cost averaging by letting the market determine when I'll be allocated shares, and when I am allocated shares because I got money from selling the puts, it lowers my average cost. And not every one, I've had one expire already, and it expired just with a gain. I get to keep the money. So because you're not going to get allocated each time, all those other premiums just keep building up, and it really does lower overall the average cost basis that you do get. So I am doing that on DHI, Lennar, and XHB. Hardly any movement here for the week. DHI up 0.43, Lennar down 0.19, KB Homes up 3.81, Toll Brothers up 1.15, Pulte 2.1, Hovnanian 8.16%. This one has been impressive. Their 1 month gain is almost 25%. This is, I like the housing sector in the U.S. because of the shortage of housing right now. It's one of those sectors that if you were thinking about, growth, a low growth environment or a high growth environment, and let's say this is sort of the middle, call it trend. We're somewhere down here below trend. Housing is going to do well in this low growth environment only because you have a shortage. If you end up with a high growth environment, housing is going to take off. Housing is going to be incredible for the home builders. So it's a good environment now. It could be a great environment if growth really ticks up. If you continue on the trajectory here and you get negative economic growth, yeah, the home builders are going to suffer like the rest of the market. But I would see that as an excellent opportunity to get my full allocation at that point if we do hit a recession, if something does break, if prices do drop significantly, I wouldn't hesitate to get my full allocation to housing, because the next cycle up, a recession is not going to improve housing supply at all. So I would certainly abandon the allocation factory here, and I would just get my full allocation. Mortgage applications for May 5th up 6.3%. We're seeing that high mortgage rates are not really deterring home buying and refinancing. Refis up almost 10%, purchases up 4.76%. This Tuesday we get the NAHB Housing Market Index still sitting below 50. The expectation here is for 45. Building permits for April, housing starts for April come out on Wednesday. For Thursday, existing home sales for April are out. Okay, CPI. Let's have a look. 0.4. You can see where we've been over the last little while here, from last July when it was 0, when you had Biden coming out saying inflation is 0, folks, it's gone. It's gone. Well, this is what it's looked like so far. So if you kind of smooth it out, it just looks like a kind of a sideways trend in there, right? 0.4, all items, headline 0.4, up from 0.1 last month. If we look at commodities, all items less food and energy, 0.4, basically unchanged over the month. And you can look October 0.3, 0.3, 0.4, 0.4, 0.5, 0.4, 0.4. That's a sideways movement. Commodities less food and energy was 0.2, now 0.6. So that is higher. And we look at services less energy services, 0.4, also unchanged from 0.4. The red dots are where you saw a decrease in each of the categories. There's food, all of this, well, better color there, there's food, all of that is energy. You see new vehicles down a bit here, and transportation services and medical care services. Transportation services make sense because, well, energy is down. Let's have a look at the Atlanta Fed underlying inflation dashboard. It has, I think, 6 or 7 different measures of inflation. All right, the link for this is in the description box below the video. This is from the Federal Reserve Bank of Atlanta underlying inflation dashboard, and it gives you this chart with a number of measures over here. You have the average between 2009 and 2019 for reference. So if you look down this column, this is the 10-year average, 2009-2019. Well, I guess it would be 11 if you're including all of 2009, right? 11 years. Core CPI. This is April 22, April 23, 12-month growth rate, 5.5%. The Cleveland median CPI, 7% versus 5.4 in April 22. April 23, 7% for the median CPI. 16% trimmed mean, 6.2, now 6.1, kind of sideways. The Atlanta Fed sticky CPI is 6.5. Last April was 4.9. So when you hear the governors or the Fed officials saying we're seeing no progress, you have to look at the measures they're looking at, not the way that you slice and dice them, but the way they're looking at it. And this is what they're seeing. They're saying, well, median CPI is 7%, not 5.4. The 16% trimmed mean, really no progress. The sticky CPI is 6.5 instead of 4.9. It's going in the wrong direction. Core PCE, 4.6. Last year was 5, so it took a whole year to drop 0.4. So if we're waiting for that to get back to 2, if it took a year to drop 0.4, a linear forecast would say it'd take another 6 years to get there. Market-based core PCE was 4.9. This is 4.7. The Dallas trimmed mean PCE is 4.7. Last year was 3.9, so that is higher. Look at this one. The San Francisco cyclical core PCE, 7.9 instead of 6.3. This is cyclical core. So there is sticky core, which Atlanta Fed has up here, and there is cyclical core. The core that is more the price items that are more cyclical, that are more flexible, and the cyclically sensitive inflation, 6.7 instead of 5.5. So half of these come in higher in April 23 than they were in April 2022. This is kind of a neat chart because it gives you a nice visual of the distance from where they hope to be. So you have the green line down here, which is their target based on 2% core PCE. And the most recent 60-month moving average, I don't know why they call it a moving average. I don't know, well, they should just call it an average because it's not really moving. It's just flat at 2.9. So I think maybe they used the wrong words. This is the Dallas trimmed mean PCE, and here is where it happens to be. They haven't updated it for April yet, but there's March. We'll look at April's, we already looked at April's CPI. We'll look at April's PPI next. And you could just drop down this menu. Let's say there's core PCE. And you can see how elevated it is over the 60-month moving average, which is higher than the target. So, looking at that, going all the way back to 1990, you can see that this is still elevated above those levels. This does not look, even if it comes down to the 4, this still does not look like a Fed that says, okay, let's start cutting rates. They're not going to start cutting rates until they see it well below that orange line and dancing on top of or very near that green line, which is quite a ways down, and to see it there for an extended period of time. Let's look at sticky CPI. All of them are showing the same pattern, right? Market-based core PCE. There it is, still elevated there. So there's a lot that you can play with on this one. So I would suggest that you click on that and see if it matches the beliefs that you have. Okay, PPI. We have final demand goods, final demand services, and then you have the stages on this side. I've basically just gone to the bottom. I've looked at March and April and where the index is increased or decreased. So total final demand is up in April over March from negative 0.4 to plus 0.2. Final demand less food, energy, and trade is up. Final demand for goods, it breaks it down to goods and services. Final demand for goods is up from negative 1 to plus 0.2. Food up, energy up, less food and energy is unchanged. Final demand for services total is up. Trade up, transportation, warehousing is the only one that is down here. Others up. Let's move over to the stages. Stage 1 feeds into stage 2, feeds into stage 3, feeds into stage 4. Stage 1 up, up, up for total goods and services. Stage 2, intermediate demand month over month, up, up, up. Stage 3, demand up, down, and up. And stage 4, up, up, up. PPI, month over month, that's going in the wrong direction. CPI, month over month, that's going in the wrong direction. This does not look like data that is consistent with the Fed thinking that June does not have a 25 basis point rate hike in it, right? This may give them cause for pause. Hey, that rhymed, cause for pause. Maybe that's the new slogan. We're looking for cause for pause. It's easy. You can repeat it. 264 on initial claims, seasonally adjusted, up 22,000. That's one of the highest numbers we've seen for quite some time. Non-seasonally adjusted, it's only up 13,000, but still up. You had a lot of layoff announcements at the beginning of the year, figuring they take 60 to 90 days to put into practice. Some of those people are going to walk away with severance. If you have severance for a period of time, that doesn't that eats into your unemployment period. You have to wait for your severance to run out. So maybe we're starting to see the first of those layoffs really starting to appear. The insured unemployed rate seasonally adjusted 1.8 million, up 12,000 from the week before. Non-seasonally adjusted is 1.6 million, actually down 22,800. Again, not adjusting for seasonality. There is some value in looking at the non-seasonally adjusted numbers, only because it seems the seasonal adjustments are really off because of the pandemic. They messed up a lot of things. So I don't know that the seasonally adjusted numbers are actually picking up the underlying trends as well as they should be. The non-seasonally adjusted, yeah, well, you're getting seasonality in there. So, it's down 22. But should it have been down 30, accounting for seasonality? If that's the case, then that results in, well, it's up 8. It's 8 higher than it should be because it only dropped by 22. But during this time of year, on average, it should drop by 30. That's how that works. This is saying, well, because of that seasonality, it dropped 22. It should have dropped 34, so it's actually up 12. So if you have reads that are hitting between 260 to 300, 275 to 300 is fairly consistent with no job growth, and you start printing numbers of 0 jobs month over month, or even negative jobs month over month, even with all of these plus signs going on with if you have this going on, that might be the condition for a pause, but still not a rate cut. Not until you see a bunch of negatives here instead of positives for a couple of months, 3-4 months running, and elevated initial claims for 3-4 months running, would you then even begin to say maybe they'll be talking about a cut. Maybe they'll be talking about a cut, but we're a long way from this. And some fairly smart people that watch inflation a lot are suggesting that this is not going to be a 3 or 4 month progression, but this is going to be a several year progression, 3-4 years of inflation running between 3 and 4, maybe even 3 and 5%. That this idea that it's going to come back down to 2 is not going to happen unless you get something breaking and a global recession, which creates a lot of capacity in the system. But if you get that, well, then you don't want to be in equities, but you do want to be in duration, right? You want duration, but you don't want to be in equities. Negative beta, positive delta. How many weeks have I been pointing out that is my position? Consumer sentiment on Friday. None of this was good news. Index of consumer sentiment 57.7, down from 63.5. Current economic conditions 64.5, down from 68.2. And index of consumer expectations 53.4, down from 60. The 5-year inflation expectation came in at 3.2. Previous it was 3%. Inflation expectations for May came in at 4.5. Previous was 4.6. And they also provide this little chart saying, yeah, you have this down to 53.4, but look at this. August 2011, the last time we had a debt ceiling issue, look at what happened to consumer sentiment ahead of it. The debt ceiling was lifted. Look what happened to consumer sentiment after the fact. True, but this level here, as I point out, is also consistent with deteriorating economic conditions here and here. So yes, you do have a debt ceiling debate going on, but is it, if we look at the leading economic indicators, you look at PMIs, you're starting to see it maybe in initial claims that the underlying economic conditions are deteriorating a bit. Warren Buffett said in his annual meeting that he expects most of his operating companies to have lower earnings this year. Another another interview that was kind of making the rounds of the discussion last week with Stanley Druckenmiller at the SON conference, SOHN. So if you go to YouTube and Google, well, yeah, you can Google it. YouTube is Google. Go to YouTube and search SON conference Druckenmiller. You'll find his discussion that was rather negative as well. And when you get Buffett and Druckenmiller both saying that their outlook is to the negative side this year, you sort of have to pay attention. If you had to sit down and have lunch with these guys, I'm sure you'd be asking those questions and saying, "Look, you guys have been doing this for a long time. I can take your word for it that you're informed with some experience." But there is something here, right? You did have this issue going on, so that highlights that. Well, for the next couple of weeks, I don't expect there to be much progress. However, if there is a deal that happens, it probably would be positive for sentiment. It probably would be positive for equity. So, yeah, for the next couple of weeks, I expect there to be downward pressure. I think the Fed speak this week will slowly start to flatten that Fed funds curve. I think the probabilities of rate cuts will start to get priced out of the market. Which means higher for longer. So higher discount rates means higher real rates, lower stock prices. If that happens over the next couple of weeks, I'd be careful about adding a lot of negative beta at that point, because I'm pretty sure you're going to get a resolution to this debt ceiling because the outcome is just so bad. You'll get a resolution to it. It won't be the best resolution. It'll be ugly. It'll be an ugly finish. But once you get that, even if the market retreats, 100 points over the next couple of weeks as we head into the X date, or 150 points, you can get that all back in one day. Hey, we have a deal. We are going to kick the can down the road till next February, and the market will say, "Oh, well, that's so far away." They'll get it solved well before February, won't they? I mean, they'll get it solved, right? And then up will go 150 points. So this sort of highlights that, there's risk event. If you have short beta, if you have negative beta, your risk event is the eventual resolution of this problem. Okay, we are going to talk about copper, because copper was in the news last week. And for those that regularly listen, you know that I've been sort of bullish on copper and miners for quite some time. And I am looking to take a significant position in the miners. I do know that we have the potential of a recession in front of us, so that would be a negative, but I am collecting my position slowly. If there is a recession, much like with housing, I will not hesitate to take a full allocation. This is the International Copper Study Group. I didn't know that it existed. I was reading an article in the Wall Street Journal, and they listed this as a source for something. So I said, well, let's go check this out. And lots of really great stuff in here. The World Copper Fact Book is really interesting. Latest press releases, really interesting as well. Lots of good information here if you are interested in Dr. Copper. A link to this is in the description box below, but if you Google International Copper Study Group, you'll find it. Okay, up on the screen is copper. This is HG. This is a 2-year chart of HG. And I'll just isolate this. This down here is just this little area here. This is just the last 2 weeks. You can see a big dump on the price in copper here. So I am using COPX, which is an ETF that tracks copper miners. I'm selling at the money puts. I am being aggressive on that. IVP is fairly good, 13-week IVP at 56%. So I've sold the May 38s a while back. Last week I sold the June 37s. They don't have options other than monthly. So that's all I have available is the monthly options. From the Wall Street Journal, last week, or I think maybe even the week before, I'm not quite sure, but it was recent. Copper shortage threatens green transition. Challenges in opening new mines expected to leave production lagging behind rising demand. This was, I think, an interesting paragraph here. There's no slack in the system, no buffer, said Marix's head of market analytics, Guy Wolf, at a recent conference in Switzerland. He said that copper was the only metal with locked-in demand growth, but indicated prices would need to rise to $15,000 a metric ton to attract investment in new mines. So just to attract investment in new mines, you'd have to get copper to 15,000 a metric ton. This price over here, 372, this is per pound because the US is still using pounds. So what would be the comparable price in pounds? Well, it would be 680. So we take a metric ton, figure out the price per kilogram, and then you have 2.2 pounds per kilogram divided by 2.2. 6.8, 680 a pound versus 372, and that's just, in his opinion, that's just to attract investment in new mines. Futures on the London exchange are now around 9,000 a ton. And some in this story, some numbers were given in terms of demand. 2021 demand was 25.3 million tons. 2031 forecast is for 36.6 million tons. In other words, 44.7% more. The supply forecast for 2031 is 30.1 million tons. Demand 36.6, supply 30.1. So you've got a deficit. Mined output in 2022 was 21.8 million tons. So copper is I think the easiest bet to make on where we're going globally. You have an energy transition that's occurring in wind, solar, in EVs. Even building houses takes a lot of copper because that's what electricity travels on. It travels at the speed of C/2 through copper. There's nothing that is a better conductor for electricity. And EVs take, 3 times, 4 times the amount of copper as an internal combustion engine does. So if all of these targets are going to be hit, actually, this is interesting. This demand forecast of 36.6 is a light demand forecast. In other words, it's not a forecast of everybody trying to hit their targets. It's a forecast assuming that, well, not everybody's going to hit their targets for EV. Some countries want no EV sales by 2030, by 2035. That's not in here. If every country tried for a net zero approach, if they put themselves on a net zero trajectory, you'd have to increase this by 54%. It would be even worse. And last year, when I did the video for the Ice Age will be with us for quite some time, or the Ice Age is far from over, I made that case that you are going to hit a wall of supply where prices are simply going to go vertical to the point that you're not going to be able to afford to do it at the speed that you want to do without massive inflation. So you're going to have some kind of transition plan for a period of time. Now, if you look over at traditional energy, they're not investing in new fields. So you have 2 supply crunches coming up. Number one, traditional energy is saying, we're not drilling new stuff here. You're going to take what we get and that's it, and we're going to manage supply. And you have a mining complex that simply hasn't got the supply capacity to meet the demand that's going to happen. Copper, to me, is a pitch right over home plate. Why you wouldn't want to load, well, I shouldn't say why I wouldn't want to load up on this, I don't know. As far as miners, FCX and Rio are the 2 that I would play most predominantly. FCX was down 4%, Rio down 1.3%. I welcome these opportunities. When you're trying to collect, when you're trying to allocate or build an allocation, you don't want prices rising while you're doing that. You want them to remain soft. I'd like to see them go a little bit lower so I can get them at a lower price. But after reading this last week, after visiting the site I just showed you and poking around and looking at different forecasts from people whose life is about copper, and everywhere I go, I hear the same song being sung, is that there is not enough mining capacity to hit all of these aggressive targets. There's simply, either the price is going to get squeezed upwards to the point of inaffordability, or you're going to have to delay these plans. And as this guy says, Guy Wolf, is prices would have to get to $6.80 a pound just to attract new investment in mines. Now, this story went on to point out that the larger companies are growing their copper capacity by acquisition. That the mining companies right now are buying other mining companies to acquire their mineral rights as opposed to CapEx. Well, that does not increase capacity. It only increases concentration. So, yeah, this is sort of a higher conviction trade for me. I've got a couple high conviction trades for the next cycle. Copper being in metals and mining probably being the highest one, but metals and mining definitely. Housing, U.S. housing, if I could find some good Canadian plays on it, I would, but they just simply don't exist, and I think we have a bigger housing problem in Canada than the U.S. does because of our immigration policies. And mortgage REITs. Okay, this is an opinion piece that was in another publication. Alarming drop in mining derails drive for net zero. And whenever there's an opinion piece, your first assessment is who wrote it. Heather Exner-Pirot is a director of energy, natural resources, and environment at the Macdonald-Laurier Institute. Okay, so this is her wheelhouse. Okay, so I'll read it. Green transition will take 6 times the mineral output world is producing now. That is consistent with other studies that I've read from other sources, is that we simply just don't have the mines in place right now to produce the capacity that is being demanded. Mining investment is anemic around the world, having plummeted 35% between 2021 and 2022, a victim of high interest rates and price volatility. Overall, global mining financing is barely a third what it was a decade ago, falling from $119 billion at the peak of the last commodity cycle in 2013 to a dismal $42 billion last year. Far from growing mineral production for a future net zero world, we are living off investments made in the past. The 38th edition of the World Mining Data Report. So I looked it up and I went there and I downloaded it. And if you're into tables, table after table after after table, this is a report for you. The 38th edition of the World Mining Data Report, published annually by the Austrian government, finds that mining production is not meeting the hopes of governments working to increase their own domestic and friendly sources of minerals. Rather, production has roughly plateaued, with the sector yet to match the peak production of 18 billion metric tons achieved in 2019. Far from growing our outputs, we're struggling to maintain them. So you have more and more countries that are joining in the idea of let's move away from internal combustion by 2030, 2035, 2040. Let's go full battery. Let's convert wind, solar, all of this drive. You can encompass it all into this umbrella term net zero. And this is consistent with what I've seen in other places. We'll take 6 times the mineral output the world is producing now. That is going to drive prices up. And if you drive prices up, energy prices are going to be the thing this decade. Elevated energy prices, because if you're giving up traditional sources of energy production for these new sources of energy production and you're paying for it at the peak of their pricing because of the supply wall that you're going to hit, then energy prices are simply going to have to be higher. And GDP growth is energy intensive, which means that's going to find its way into everything. So either we give up on this and say, look, instead of a 10-year plan to get there, let's get a 50-year plan in place. And let's not demonize the traditional energy companies, because we need their help right now. If we expect cheap energy and cheap GDP growth, we need their help. And right now, they're not investing. They're not exploring. Why would they? Why would they? With governments holding knives to their throats, I've said this many times, why would you spend the money on anything on new CapEx when governments are threatening to cut your corporate throats in the next 10 years? This is a big deal. I think the money to be made clearly is in copper and in the mining and metal sector. Okay, forward 4-quarter earnings, 222.72. And again, I couldn't find the updated spreadsheet. So Howard, if you're out there listening, I don't know where it is. Couldn't find it. But anyways, we'll use the last numbers we had. SPX closing 41.2385, 18.5 times forward earnings. Inverse of that is 5.4, 10 years 3.46, 194 basis point spread between the two. Implied volatility disappearing again, down to 5%. If we look at the last 13 weeks, it was 9%. We have this issue right here, 41.50 to 41.75. It's been quite some time, 6-7 weeks now that we've been bouncing up against that. This is where it was last time as well. You can see some consolidation here as well. And I think with the debt ceiling debate going on, I think with the uncertainty around interest rates, I think with the Fed officials saying, look, you guys got it all wrong, we're not cutting. I think with inflation showing a move up consistently month over month for the month of April, I think price risk in the market is more to the downside than the upside. I don't see us breaking out of this range with all of these headwinds and pushing higher just for the sake of pushing higher. I can't see it. I've had no changes in position on SPY over the last week. There's really been no opportunity to either cover any of the short puts that I have or any of the short calls that I have. And theta is just working nicely for me. So at this point, I'm getting theta on the puts and the calls. I'm more than happy to sit and wait. But I think we're some 36 days away from the June expirations. So, and 3 weeks away probably from any kind of resolution of the debt ceiling. If I had to bet today, gun to my head, where we would be by the end of the week coming up, I'd say lower, only because of all of the Fed officials that are speaking. And I don't think they're going to speak at cross purposes. I think they all have their talking points, and I think they're all consistent, and I think they're all on the same page. So hearing it again and again and again, I don't know if the market can take that many more bullets in the chest. Every time it gets a bullet in the chest, it just seems to get back up and wants to march on forward. Well, there comes a point where, just like Scarface at the end, you can only take so many bullets in the chest before you're done. IV last 13.8, that was really low. So that I'm working on the home builders by selling 30 deltas. What I'm doing with COPX. I'm still interested in the miners. I'm looking to buy more agency. Other things I've done, I've sold Oxy June 55 puts on the weakness. I also sold CAD. CAD retreated a bit. I sold CAD for July. This is the futures for July. The 75 cent puts at 135 pips. That puts my break even, if you put it in the form of US.CAD, puts my break even at 1.3577. So anything below that, I make money on. I have the September underlying here. So I've more than overhedged at this point. This would no. I'm more than overhedged. I have to keep reversing in my head thinking, okay, well, I'm using the CAD futures, I'm using the 75 puts, which is the same as the, then you reverse it in your head, and I think I got to reverse my position. I am overhedged, which means I am basically, I have an active open position on the Canadian against the US at this point. Other than that, there's not much to say in the market. At this point, I think we all know the story. Earnings came in fairly good. If you look at the earnings of some of the tech companies, though, you have to kind of scratch your head a little bit. Look at Google and Microsoft, for example. They have restated the useful life of their servers from 4 years to 6 years. Both of them did that to add $1 billion to operating income. If you look at their cash flow from operations, both of them have decreasing cash flow from operations. Both of them, year over year, decreasing cash flow from operations. Google's growth rate in revenues is under 3% year over year. Microsoft's growth in revenues is under 10% year over year. Both have shrinking operating cash flows. Both had increasing operating income because of the reclassification of their servers' useful life from 4 years to 6 years. And most interestingly, if you look at investment, cash flow from investment, year over year, Google went from $9 billion down to $3 billion in reinvestment, and Microsoft went from $17 billion down to $3 billion. And all the thinking is that AI is going to require far more computing power. What's going on here? Underinvestment, reclassification of assets to have a longer useful life, shrinking lower operating cash flow year over year, revenue growth below 5%, below 3% for Google, below 8% for Microsoft. And if you look at the rally, 5 stocks have been responsible for, what was it, 80-90% of the rally on heavily engineered earnings. But when you look under the hood, it seems like a rather curious thing that's going on there. As far as margins go, not seeing the impact of lower headcount at any of these companies, even though they've all announced layoffs, not seeing that impact at all. Being that the story is in on earnings, being that we've gotten some big data points so far, I don't know. I can't see the upside at this point. That if I had to bet, it's to the downside. For this week. However, I would not load up on negative beta as it was dropping, only because you just might have peace break out in Washington. And if peace breaks out in Washington, then it could add to sentiment and investor sentiment, and you could get a rally. That might break us out over this range, if ever, if for only a brief period of time, but it could have the potential to do that. Let's look at our economic calendar and our earnings calendar for the week coming up. Okay, this week we've got retailers: Home Depot, Target, Walmart, Ross Stores. For those of you that are into farming equipment, Deere has been knocking it out of the park. Last few earnings releases. Let's see how they do. Going into next week, you do have some retailers here. You have AutoZone, Lowe's, Dollar General, Best Buy, Dollar Tree, and Costco down there at the bottom. So some retailers this week, big ones, Target and Walmart, their guidance will be market moving, I think. Economic calendar. Okay, on Monday, you can see a lot of Fed speak going on when you see the medium. There's Barkin, Kashkari, Bostic. We've already been through that, so let's just point out what we get this week. In Canada, we're going to get our inflation rate on Tuesday. That will be a risk event for the dollar. Also at 8:30, retail sales for the U.S. Let's see what's going on with the consumer for the month of April. As we keep going down, we've seen all of this stuff. You can see all of the Fed speak as I scroll through this. We've noted building permits already. Let's keep going down. There is leading indicators. There it is right there. The leading index from the conference board. That's at 10 on Thursday. And then Friday, that's going to be potential. Well, I don't know if he's going to say anything in there, but that he would not say something would be odd. So I think that'll be an event to watch. And you can watch it live. The link is in the description box to get to the site, which has the link for the live event.